All right, everybody. Hey, welcome to our Note Nation Top 40 tour as we focus on the Kansas City market out here, everybody. Not just Kansas City. We're both on the Kansas City, Missouri, and the Kansas City, Kansas part of the aspect of things. So we actually are focused on two states tonight and the city that hooks them both together for you. But welcome to the Note Nation tour, everybody. We are honored. This is our 26 out of 40 city. We're roughly about a third of the way left. We've got a variety of local and national investors that are investing in Kansas City. Not only there locally, but people from across the country out there. You can always check out the replays for all the markets and the upcoming cities that we have left on the tour by going to notenationtop40.com as well. We'll be discussing statistics and the numbers in the Kansas City market. We'll talk about what the second half and outlook looks like for everybody out there, along with future opportunities and how to tap into them and where to look for them. So we'll also talk about how to get started as well for you. So a lot of guys and gals, if you don't know who I am, I'm Scott Carson. I'm the been an active real estate investor since 2002, over 16 years in the mortgage and debt markets out there, purchased over $500 million in debt. I'm the CEO of WeCloseNotes.com, where you can check out our home site, where you can check out all the podcasts we have, the education and the other classes that we do. I've been teaching investors since 2004 how to tap into real estate, and I'm the host of the Note Close Show podcast, which is syndicated across the country with millions of listeners each month out there. But I invest all across the country, even though I live in Austin, Texas, and Kansas City is one of those markets that I invest in. So our mission has always been to help investors accomplish their goals and dreams and increase their wealth through debt investing. And people ask me all the time, Scott, why are you going to take time to be sitting here at home working through 40 different markets? And I tell people this because I love to help investors. I think there's a big opportunity. And if you take action now, you're going to be sitting a whole lot better off in the near future because of the different opportunities that are available. I do love to help people solve problems, whether it's investors or it's borrowers that are struggling to survive. I do believe that this is the opportunity. And I'm empathetic with the borrowers out there because I was once a distressed borrower as well. Going back to 2000 when we bought our first house, a year later, I was struggling to get by because of a couple things, being laid off and other things. So I empathize with the borrower. Obviously, I'm not in that now, but there's a lot of good that can come from helping people out there. And there's nothing greater if you're an individual who's looking to help people, helping someone overcome an obstacle or achieve a goal or dream that they once thought was impossible. And keep this in mind, everybody. There's a lot of people struggling that their dream of home ownership or owning a business is struggling now, okay? It's not a good thing. Their dreams have turned into a nightmare, and it's up to us as investors and people out there to really be able to flip that switch and turn it back into the dream. And I've set a big goal for myself and my company to help over 1,000 real estate investors in the next 12 months really do some good out there. So where are the opportunities? Everybody asks me this all the time. Well, Scott, where should I be looking? And I tell them everywhere, all right? There are opportunities literally everywhere if you know what to look at. And I don't care what class of asset you're looking at, whether you're looking for self-storage or apartments. Those are the two hottest things. If you're looking for single-family homes, that's always going to drive the market. Maybe you're looking for mobile home parks or parking storage, or maybe you're looking for office buildings that are in default. Maybe you're looking for hotels, motels right now because you want to add that to your aspect. I don't care what you're looking for. They're everywhere. And the beautiful thing about this opportunity that's right now, guys and gals, don't care what your credit scores are. We don't care how old you are. Don't care if you're seasoned or brand new at it, okay? Don't care if you've been a successful business owner or a failed business owner. There is an opportunity right now, like there was a decade ago, 12 years ago, to do some good, okay? And I don't care whatever your long-term goal is or even short-term goal for a lot of us out there. Look, there's a lot of opportunity. If you're struggling and you don't think you can make it, look, now's the time to do something different. Now's the time when everybody's running in one direction, you run towards it. If there's blood in the water, there's a lot of blood in the water right now, you can do a lot of good. So like I said, whatever your goal is, maybe it's sitting on the beach drinking pina coladas in retirement. Maybe it's spending more time with your spouse or retiring your spouse. Maybe it's paying for your kids' college education. Maybe it's retiring your mom or your dad that they've worked so hard. Maybe it's traveling more with your friends or family to see exotic places. Or maybe you just want to upgrade your crib. Maybe you need to get your own house or upgrade your toys. I don't care. Whatever your goal is, I'm glad that you have it because I think it's important, but there's one thing. You need money to do all these things, and that's great, okay? It doesn't have to be your own money. And like I said before, don't care what your credit score is. Don't care if you have capital or you don't have capital. Now is an opportunity because there are so many deals, and there's an even bigger wave, tidal wave, end of the world kind of wave rolling towards us here at pretty fast pace that you need to be prepared of if you're a real estate investor and want to tap into that. Now, what do the national numbers say? The national numbers say that obviously it's getting ugly out there. We're at currently 11% unemployment rate through June. July's numbers haven't come out yet across the board. 40 million plus people collecting unemployment. We've got a 52% of small businesses are expected to fail. That number is supposed to get worse as time goes on. The big thing is that there were 10% of homeowners that were already struggling to stay current. We're already 30 days behind before this ever happened. Yes, there were already 10% of homeowners were already a month late, okay? Now, right now, with a 7.76% national mortgage delinquency rate, that means one out of every basically 12 borrowers is 90 days or greater behind on their mortgage. They're in delinquency, not just behind, they are delinquent, okay? And that number is going to get worse. Currently, that number equates to roughly about 4.1 million Americans currently in default out there. And if you think about what happened 12 years ago, it took us 18 months from 2008 to the middle of 2009 for us to hit that 1.6 million default mark. Okay, we've already 2.5 times that in just 6 months or less. Okay, so do I think it's going to be as bad as it was 10 to 12 years ago? It's going to get pretty close with a lot of variety of things. It's just early. Now, it's all types of loans are defaulting, non-prime, which is the subprime loans, prime loans, A-paper, reperforming loans, all had delinquencies over the last few months. Okay, lenders are literally bracing for us to see up to 15 million mortgage defaults across the country. It's 2008, 9, and 10 all over again. But the commercial markets are going to be hit just as hard, if not hit faster, because they're not being bailed out by the forbearance agreements and the Fannie Mae's and the government bailouts, everybody, okay? Now, looking at the housing hardship index, this is one thing that a company does by looking at each state's individual unemployment, default rates, and kind of ranking them on a state-by-state basis. Pretty easy to see. Now, Kansas and Missouri, 2 states in there that aren't the darkest, but they're also not the lightest, but they rank pretty close to each other. Now, Kansas ranks, has 7.5% unemployment rate, so it's better than the national average. The delinquency rate is also better, 6.9%, and it ranks roughly 37 out of 50 nationally. Not bad, okay? Not bad at all. Yay for Kansas. Now, you look at Missouri. Missouri's ranks has a little bit worse unemployment, 7.9%. And then the delinquency rate is better, actually, 6.17%. So you've got a little bit above. That puts Missouri at a ranking of 39th nationally. So it's actually at a better spot for housing than compared to Kansas. Not much, but still it's good to be on that side of the ball versus being in the dark blue. Okay. Now, the thing to keep in mind here, guys, is you start looking at the unemployment rates. Kansas, like I said, 7.5%. Missouri is 7.9, okay? Kansas City falls in there at 7.8, roughly a blended average between the two, 7.8% for Kansas City, Missouri, for the whole city. Kansas City, Kansas, and Missouri, they're 7.8%. You can see peaked in April at 11.3, dropped down to 10.8. We saw a sizable, about 20% improvement from May to June. July's numbers aren't out yet, but I would be willing to bet it's probably still going to be somewhere in the 7% range. Maybe 6.9. It's hard to say. I don't think it would have spiked, but I could be wrong. Who knows with what's going on in this crazy country right now, okay? Now, looking at the Kansas City real estate market, especially for foreclosures, basically before this all happened, Kansas City was basically 1 in every 4,400 homes, with the worst zips being the 2247 and the 2533. I'm sorry, the 64129 zip code with 1 in every 2,200 homes, and the 64113 zip code with 1 in every 2,500 homes in foreclosure. Now, the biggest price point on the foreclosure is that 200 grand or less market. Predominantly, a lot. It's like a double average of $100,000 or below homes. Okay, usually the older parts of town, built 1950 or older. You see a lot of that stuff out there. You can see the auctions, obviously, month over month in June, quite a bit more than May. Bank owns were increased a little bit compared over the last month there for you. You can see that the numbers, really just spike for bank owned in February compared to others, but have really bottomed out as long with the auctions as well. Because the fact is, hey, things have been delayed for a while. Now, they did go up a little bit over a month in June versus May, but that's because they were at zero. Okay, nowhere to go but up. If you look at the number of foreclosures, you can see it spiked there in February and then obviously dropped down, starting to climb back up a little bit. Now, the thing about Kansas City is it's on par, especially in Jackson County and Missouri, the national average. We've roughly seen about 0.01% of national foreclosures across the board. Okay, right on par, not higher, not less. It's right across the board. Now, we did see nationally a big increase, 50% increase in defaults between May and June up there, 50% over the past 2 months. You know, we currently see 7.76% default rate there. We've seen 4.1 people that are 30 days or more behind. There's another 4 million in defaults. They're also saying out there for you. So we're going to see roughly here in the next 90 days or less, total of about 8 million homes in default. Now, if you look at what Kansas and Missouri have done to kind of help stop that growth, this is a heat map. And the color coordination's been different for Missouri than it has been Kansas, and what the governments are doing for the borrowers to avoid avoid foreclosures, or renters to avoid evictions. In the dark green are states that stopped it all across the board. The light green, like what Kansas had some local moratoriums or state where evictions have resumed. And the tan where Missouri is, basically the governor said, it's business back to normal, everybody. Now, Kansas, basically, eviction foreclosures through May 1st, extending order through May 26th. They're back to foreclosing now in Kansas. Missouri haven't implemented any policies for evictions to stop that out there. So, yeah, it's not quite back to normal what it was before. You do have some people worried about that. Missouri's quite a bit ahead of Kansas as far as the percentage of where foreclosures were before everything. This is as of July 11th numbers. All in all, we are going to see dominoes fall from the coronavirus, people being laid off, job loss of foreclosures increasing. It's just going to vary on how soon and where. Some states are going to push things out quite a bit. Others are going to like, hey, let's get back to normal. Now, it's going to vary a lot in what you see as far as the type of loans that was financed is what we're going to see predominantly in the foreclosure market. A big chunk of it is going to be your government FHA loans. They're at almost a 10% default rate across the board. The FHA loan, person takes that FHA loan is a first-time home buyer. Not a lot of money put down. If putting anything down, you usually got to put 3.5% down. But a lot of the government programs out there has banks literally donating the down payment and paying up to like 10 grand in closing costs for a first-time home buyer. Bank of America, big contributor to that. Traditional loans, your all conventional loans, 3.16. Your VA is the next highest at 4.65, and the rest of the loans at 4.36. So you expect to see a lot of that 200 value home or less be the ones that have the most amount of foreclosure. You're going to see some uptick in the higher end stuff, but for the most part, it's going to be that first time home buyer. Now, a lot of them are going into modifications or forbearance agreements. We still see roughly about 4.6 million Americans, somewhere in that number. The number fluctuates of those that are in forbearance agreements. Now, some experts say there's probably somewhere between another 3 to 4 million borrowers out there that haven't reached out to do a forbearance agreement that would qualify one, but they just not contacted their bank yet. Now, is this good news or bad news for you guys, for us? Well, Kansas and Missouri both have lower defaults versus the national average. That's a good thing. Same thing with the unemployment rate, okay? Kansas does have a longer foreclosure time frame because it is a judicial state. Missouri has a shorter time frame because it's a non-judicial state. Kansas City, for a traditional FHA loan, forecloses about 450 days from start to finish. Missouri is roughly the same amount for a non-judicial FHA foreclosures. They've got their process of going through some things. Now, when you look at the huge backlog of forbearance agreements, it's going to delay things across the board. You're going to see foreclosures and REOs, but it's going to be a while before those hit the market. And everybody tells me 12 to 18 months because they're going to drag things out. The banks, especially on the big amount of loans out there that are struggling, the banks have had 6 months. They're giving people 6 months to basically, okay, get back on your feet. The government is willing to give another 6 months of government-backed loans, so that's a year. The first 6 months, the banks are going to be able to look at their portfolio and see who's been paying, who's been not paying, and then move that asset off to somebody else. Now, what about commercial debt? Commercial's been hit hard as well. I think we can all agree to that. All right. We see rents all over the place. Buildings are boarded up. People are not working. People are working from home. Businesses are going out of business. Retail's struggling. Companies are telling people just stay the hell home and work from there. There's no reason for you to come to the office. We can do everything from there. people aren't going out. They're buying online. Okay. Amazon's having a record year. Okay. But commercials has been overvalued for quite a while. I've been saying this for the last 2 years, and obviously it's changed. You look at the asset classes being hit the hardest: lodging, hotels. People aren't traveling, obviously. Over 27% default rate across the board here as of June. Retail's over 15% now. Other classes like restaurants, mixed use is also struggling out there. It's not a good time for commercial banks or commercial property because it's a lot of upheaval. Now, those that are back to normal, great. But other places across the country are struggling. Now, you look at the different markets across the country. Chicago's got $2 billion in bad debt from the CMBS side. Dallas, just under $1 billion. Phoenix, under $1 billion. There's a lot of stuff out there that's being hit hard. Now, they're saying, especially with Kansas City, the development that was taking place has been delayed. They don't know if it's going to be finished out there. They're going to continue to do it or push it to next year. It's really affecting the Kansas City hotel and convention industry hugely amount. Down 60, 70% than what they expect to do things out there. You look at the Sheraton Hotel at Crestwood temporarily closed. This is a couple of weeks old. But they're basically, the number I want you to look at here is that there are currently about $300 million outstanding balances of commercial mortgage-backed security loans between several Kansas City hotels. Okay? It's a big amount. That's just from the CMBS side. That's not talking about what's on the books with the different banks out there. A CMBS-backed security loan is different than Bank of America or Chase financing that, okay? So let's talk about some of those defaulted numbers. 1 in 4 hotel loans are in default. That's not difficult to understand. 1 in 5 retail loans are in default, not late, default. That's not hard to believe. They expect malls, half the malls to fail if not ever come back. Office vacancy is set to increase to roughly 20%, close to that by the end of the year. Vacancies are going to increase by another 15%, or to be at that 15% rate on retail and restaurant space by year end, if not already there. Rents are expected to fall 10% or more by year end and increase that decline moving into 2021. Okay. Now, we talked about the CMBS guys. Yes, there's a lot of those guys out there that finance this stuff, and it's not the same as it was 12 years ago. In 2007, 8, 64%, basically 2/3 of all the loans out there on the commercial side were financed by Wall Street. This time around, the banks, though, your traditional banks have come in and financed 53% of the distressed loans, okay? Now, they're not lending at 100% or 95% on loans like single-family homes. They're financing at 63 to 70% for the most part. They're in at a better spot. But here's the kicker, everybody. If a bank finances a loan, let's just say 70% LTV, and you've got a 20% reduction in rents, 10% increase in vacancy, your value on that property based on the net operating income and the cap rate is going to tighten up. So bank may no longer be at 60%, they may be at 80%, or they may not be at 70%, they may be at 85% because the values drop. Them having 6 months to look at things and being able to work with bars, they're going to look at their naughty, the people that can't pay or aren't paying, and their nice list. Especially the commercial side, the nice list would be people who have cash reserves that can come in and write down that loan by paying that loan down. But do you really think a lot of people have a lot of huge reserves to pay down their loans to get it back to that 69, 67, 63%? Hell no. So that leaves an opportunity for us to come in to buy debt, to take over some of these assets at huge discounts and work it out in some sort of fashion. And what they say to do, hey, providing capital to buy out some of the bad loans or work with current borrowers to try to reposition the property in a variety of ways. And reposition the property, there's going to be a lot of that. We'll talk about that in a second. But literally, they expect banks stand to lose roughly $48 billion or more on commercial real estate loans. That's not just the CMBS guys, that's the banks. We're talking, the CMBS guys lost $50 billion in market value in March. Okay, that's one side. The banks are going to on the hook for just as much, if not more, when you look at what they're getting hit with, not just the commercial side, but also the residential side. Bank of America is going to be one of the biggest guys to take the biggest hits. They just announced a few days ago they're expecting to see about a $5.1 billion loss based on the sour loans. Their shares are dropping, and oftentimes Bank of America is kind of the bell cow when it comes to the residential loan business when it comes to banks. They've been very aggressive on providing loans. Well, that aggressiveness is going to bite them in the butt as well. So where are the opportunities? Is it going to be in the foreclosures and REOs market? Not for a while. No offense, not for a while. 12 to 24 months. Okay. Is it going to be in the fix and flips? No, it's not going to be in that way. If you're waiting for discounted properties, you're going to have to wait a while. Plus, a lot of the hard money lenders or the mezzanine financiers have dried up, and the banks aren't as willing to finance or refinance out fix and flips as well too for you. Is it in the rental market? No, it's not in the rental market. I don't think I want to be in the rental market. I'd be a really tired landlord of toilet stands and trash outs right now, especially if they're not paying you and you've got to evict. All right, not a good time. The real opportunity lies literally in the debt game. What do I mean by the debt game, everybody? That means buying debt at substantial discounts and then working with the tenants, the borrowers of some sort to do some good out there. And we expect to see some residential notes hit the fourth quarter. Notes, not REOs, notes in the fourth quarter this year, because now the bank has had 6 months from March to September on the government loans to see who's on the naughty or nice list. Who's paying? Okay, we'll keep them. Who's not paying? Who's going to struggle to pay? Let's get rid of those. And you're going to see some of the stuff be moved here in the fourth quarter. There's already commercial deals this quarter alone. I've had plenty of my buddies tell me, Scott, we've seen more commercial note deals come across our books in the last 2 months than we've seen in the last 2 years. And you can look at some of these listing sites like DebtX, Exchange.Loans, 10X, First Financial, FFM, all have seen an increase in commercial note sales popping across the board as the banks want to start getting this stuff off their books as fast as possible. Okay. Now we talked about pivoting. You've got to be willing to pivot some sort of, just like this guy did with this hotel. Instead of it being sitting there vacant on a brand new hotel, he turned it into apartments and was able to come out of it smelling okay. Our buddy Garrison Gilbert is doing the same thing in Pennsylvania and Gettysburg and Baltimore as well, taking smaller 40, 50, 60 room hotels and turning them into apartments because there's a big need for affordable housing out there. You look at office spaces also turning around a bit, like this guy in Denver is taking a 110 unit office space and convert it to self-storage. Pretty stoked about that. It makes a pretty good sense to do that if you've got the opportunity to do that. Now, the biggest opportunity isn't going to be in these huge $5 million plus assets. That's where Wall Street's going to play. That's where the CMBS guys like to stay, 5 million or greater. Okay? Because they've got cheap money. Anything below that really doesn't make sense for them. So that leaves a huge opportunity for investors like you and me, everybody. What do I mean by that? Well, you've got all this banks that have financed all this lower value stuff. Lower value when it comes to commercial is sub 2.5 million. This is the stuff that's clogging up their arteries worse than my grandmother's chicken. Okay? A lot of opportunities for you to step in and find this stuff that the big guys aren't looking for. The banks are looking for help. Okay? Being able to come and step in, buy the debt, and then work out something with the tenants, the borrowers, working to create a true win-win. If you're buying a note at 50 cents on the dollar or less, or 60 cents on the dollar or less, and you're not the one that has had 6 months lost in rent, but starting over fresh, that gives you a lot of flexibility with the tenants. Like, okay, I know you're 6 months behind. Let's extend your lease for another 6 months. Or let's, I know you struggle. Let's get you started back up again as your tenants are working. Let's create some win-win scenarios. And that's the opportunity, one of the biggest things for you guys out there, like we saw back 12 years ago. Okay. Now, are there banks in trouble out there? Hell yeah, there are banks in trouble. If you take a look at what's in Kansas and Missouri, we like to track a list called the Bauer Financial List. And the most recent report came out in June. Bauer Financial evaluates banks on what they have in deposit, what they've got in defaults. It tells you what they have in 90-day lates or greater, 30, 90 days, because they're pulling the information directly from the FDIC. It's a powerful list that gives us and shows us amazing thing. Thousands and thousands of banks across the country. And we know there are thousands of banks that lend in Missouri and Kansas. But if we break it down and narrow the list down by just the banks whose main offices, as they call either one of Missouri or Kansas home, that leaves us with 154 banks. They just call Kansas, Missouri home. Okay? It means they have their main office. They may be lending other places, but just as an office base located there. Now, if you look at that 154 banks, combined, they have 818 million in 90-plus defaults and an additional 342 million in that second wave, 30 to 89-day defaults as of in June. Now, we know a chunk of that's already 90 days late. A chunk of that's 120 days late. A chunk of that is 60 days on the verge of going into 90 days late. That's over it's roughly 1.2, 1.1 billion in bad debt, everybody. It averages out to about 5.3% across the board in defaults. You have 163 million in just single family homes. Okay. Single family residential loans in default. The biggest number is that 100 to 200 number. 5 times 16, basically, it's about 900 loans. Okay. That's a lot of property out there that is in default looking for some help on things. Now, if you look at the two biggest guys, banks, People's State Bank in Kansas has 62% of its portfolio in default. Okay. 62% of its portfolio in default. And the Bank of Washington has 30.3% of portfolio in default. That's in Missouri. Now, the thing to keep in mind, guys, that's not what a bank wants to be at. Okay. That leaves a lot of opportunity to step in. Now, are we going to see the wave of banks getting bought up or banks going out of business? Hell yeah. It may not be as extreme as it was a decade ago, but we're still going to see plenty that are struggling out there. Now, why would you want to buy this distressed debt? We've talked about it a little bit. The biggest thing is that, if you start buying debt now, you're going to see deals now 6, 12, 24 months ahead of what your traditional investors out there are going to be looking for REOs or going to the foreclosure auctions. It's going to take a while for it to trickle down to those things. You can start buying deals now and reevaluate the market, reconfigure that market, because we all know foreclosures, not on the residential side, of the commercial side, completely impact the market. Residential's the block, the neighborhood, the zip code, the city. Same thing commercial, the zip code, the block, the county. It all affects in a derogatory fashion. So if you can step in and buy this debt at a significant discount from the bank and then become the bank, it's going to vary on discount wise by location, foreclosure time frame, asset class, the values, condition, etc. out there. You can purchase the debt and then control the asset by picking it up at a huge discount and then really working with the tenants or the borrowers. Your strategy could be to reinstate, modification, short sale, take over the loan if you need to for cash flow, turn it into a reperforming note, or take the asset back and add it to your portfolio and do what you want with it. So many great things that you can do with the debt side, whereas it's not the same as a foreclosure where I just got to buy it and sell it or rent it out. No, we've got a lot of flexibility that you can make some really good return on investment and return on time without having to do all the heavy lifting out there. Now, other advantages are, first thing that most investors struggle with in traditional investing is the marketing side. We don't send out thousands and thousands and thousands and thousands of dollars in postcards or yellow letters or bandit signs or stuff like that. We don't do that. We're dealing with banks, asset managers. They're not going to answer a yellow letter. Hi, my name is Scott. My wife, Stephanie, and I would like to talk to you about buying your house. No, that didn't happen. I just vomited a little bit. What we do use, though, is the 21st century, and Scotty's here to beam you up. I'm giving her all she's got, Captain, to help you realize that if you've got email, you can jump on LinkedIn, or you can pick up the phone and dial for dollars by knowing what to say, what not to say. You can actually find a ton of deals for minimal marketing costs. And one bank is going to lead to regular deal flow, not one property from 5,000 postcards and then do it all over again. No. I have some banks that have sent me lists every quarter for the last 6, 7, 8 years because I'm on their note buyer list. It came from phone calls or email blasts, okay? You can cherry pick the best deals for your portfolio if you want. You can wholesale them, flip them to somebody else if you get something that doesn't make sense. If you want to buy in bulk, guess what? You can put the money together and get better pricing by doing that. And yes, it's a lot of the same things to find both residential and commercial assets. And yes, the banks will sell you stuff. You know, you're not going to buy a one-off residential note from Bank of America or Chase. You're not going to do that, but you can buy one-off from smaller regional banks, smaller banks. You can also buy commercial notes from the bigger banks because they've got specific lending institutions just for that side of the sales side. And look, if you don't have the capital yourself, like I know some of you are thinking, that's okay. Go out and raise capital from other investors to fund the purchase. Go out and find other investors to take it off your hands. And guys and gals, we were at 15 million homeowners underwater in 2010. We're going to get close to that. That means millions and millions of commercial properties as well are going to struggle. Now, are there investors out there? Heck yeah, there's a lot of investors out there. If you look at what's going on just in Kansas City, out of the $9 trillion in retirement funds out there, I mean, there's a ton of it out there waiting for investors to call. In Kansas City, the Kansas City metro area, there's 18,000 investors with an IRA, okay, that have an IRA, individual retirement account. A lot more than that have 401k sitting on the sides. Out of that number, 12,000, 2/3 of them have at least 150 grand or more in their accounts. How many investors do you need to talk to raise $1 million? Not much, okay? Out of that, if you wanted to, basically, if you don't want to raise capital, guess what? There are 20,000 real estate investors that call themselves that file their tax returns that you could flip the deal to. Go find the deal and flip it. Be a deal engineer. Put deals together, whether it's raising capital or flipping it to somebody else and make a 5, 10, 20% or more wholesale fee. If you're buying stuff cheap, leaves a lot of room for you to put some good money on there for yourself. And I always ask you, do you want to be the banker or the borrower? And the thing is here, everybody, you want to be the bank. The bank always wins. There is so much money out there. You're already in the note game, everybody. You're just paying money out versus it coming in. The banks aren't in the short-term rental. They're not in the fix and flip game. They're not in the property management side. They are in the debt game. And that's why they're the biggest institutions out there, and also why it makes for an opportunity for you guys to step into the bank's shoes to buy some of this debt that they financed, okay? So how do you tap into the tsunami of deals? How do you ride that wave and surf it all the way into your pocketbooks? Well, I've been teaching real estate investors about notes since 2010. I was a note educator of the year a few years back. I've helped thousands of investors purchase their first non-performing note or even performing note for the portfolio. Whether it was residential, commercial notes, we've done both and done a lot with both, over thousands of individual assets over my 10 plus years of experience. And whether you're looking for cash flow, great, or you're looking for asset growth, you want to add some properties to your portfolio, you can do both with what we're talking about. You can buy one-offs or bulk. You can do trades from as little as like 25,000 up to 5 million. Okay? That's the big thing. You don't need to have a ton of money to do this. There's plenty of opportunities out there on a one-off basis or smaller values if you want to, but you can also go big if you want to. And the bank doesn't check your credit. They don't look to see if you're on time with your payments. They just want to know, can you fund, and are you going to have the right team in place if you've got some vendors or stuff like that to take care of it. And you can, like I said before, you don't have to drop money month after month after month on marketing. If you're willing to jump on the phone, willing to send emails or jump on LinkedIn and follow the forms that we teach, you can really tap into deals today. So whatever your focus is, like I've said before, single families, apartments, hotels, retail, self-storage, office, mobile home parks, whatever you want to do, there are deals in all asset classes. Whether you want to help a single family home, you can really create win-win stories for the borrowers out there. People have been in their house for years. Hey, it's not their fault they've been laid off. There's not their fault COVID ransacked the economy. You can do a lot of good and really get some great stories of helping people, whether it's on the small side or you want to go on the high-end side, or you want to go on the commercial side, maybe you want to start off with apartments. Whatever it is, guys, there are deals everywhere, and you can do it big or you can do it small. I always recommend, hey, starting off a little small, get things rocking and rolling, kind of like Gene did here. Gene started off, when we met him a few years back, he was buying some deals in his hometown of Elkhart, Indiana, working full-time as a hotshot driver and doing okay. He took our class, took our training, spent some time with us. Fast forward a few years now, he closed on over 135 assets. He was scared to raise private capital. Now he's raised over 13 million in private capital, and he's putting $1 million, 7 figures in his pockets out there. That's a big difference than just trying to get by. Talk with Laura Blunk out there, who just moved to her dream house in Maryland on the water. She's from south of Austin in a town called Wimberley, Texas. And she was like many real estate investors out there, taking classes, trying to learn how to do what to do, trying to take that tool belt, go to classes. Oh, I'm going to try to wholesale. I'm going to try to do some options, try to do some wraparound, some light rehabs, whatever money she had. She was scared to raise capital. Fast forward about 18 months after she took our training, she's going on 15 deals, raising capital on a regular basis. She's getting ready to close on a big trade. She's closing over 100 deals already, okay? Now she's getting ready to close on a trade of over 100 assets of performing notes at 53% of value. It's like an 18% cash and cash return. $4 million trade that she's taking down with other people's money. You can do it. If Laura can do it, you can do it. And it takes us also like Keith. Keith's probably one of our senior investors out there. Got a lot of experience fixing, flipping, doing other things, working in water treatment plants. I think he was a mayor of a small town in Ohio. He learned a note business from us a few years back, and I'm excited to say that he sent me an email recently and said, Scott, we're going to make $1 million this year, 7 figures, and we're looking so much forward to what 2020 has to offer because we know the opportunities out there. And all these guys, guess what? It wasn't get rich quick overnight. It was building wealth by doing the actions that you have to do. Do they be coachable? And all of them were coachable. And like I said, I don't care what your experience is. You don't have to have a lot of real experience or anything. Kind of like Raphael did here. He had no experience. He rented a place in San Diego. He was a business owner. He owned 15 full-time employees with his car detailing business. But when COVID came to San Diego, he didn't own a house, and he had to let a lot of people go. Nobody wants to drive their car or have somebody come over and clean their car. So he had to let his whole staff off. But luckily, he'd started learning this a few months earlier. In November, December, his first 30 days, he bought 5 deals. Used his own money on the first 2 and bought 2 non-performings, got them performing at roughly an 18% cash and cash return. That's not too bad for your own funds. The other 2 he's going to flip and make a good return on it. And then the 5th one, I think he's still working through. But he started off with no experience. I just talked to him the other day on a deal he's working through. He's so happy he found something, because he would be in a whole lot of hurt if he didn't learn how to do investing and how to do this the right way. He's so excited with what the year has to offer. 2020 is going to be an amazing year for all of these people and a lot of our students, because they're doing the right things. They understand the opportunity that it's everywhere. And now is the time to start building those relationships. And so that come the end of the year, come the 4th quarter, you're rocking and rolling. Just like the thousands of other investors that we have helped over the last 10 years take their businesses to whole new levels. How do they get started? By taking our training. And the first step, if you want to look into dip your toe in the waters, ladies and gentlemen, I would recommend our Note Weekend training. It's the first thing that I would recommend. It's a 1-day class, online class with yours truly, helping you get your note business rocking and rolling, helping to figure it out. You don't need to learn everything in 3 days. You're not going to learn everything about the note business in 3 days, let alone 1 day, but you can learn a lot of stuff and understand that, hey, this isn't as complicated as most people make it out to be. The note business is doing a lot of the same things over and over and rinsing and repeating, and it's getting in the right direction. If you've got some real estate experience, this is going to be awesome. If you don't, guess what? This is a great starting point for you to figure things out and get rocking and rolling. So, like I said, it's a 1-day online note training. It's basically a mini workshop with yours truly. Our students call it the Cliff Notes version of training. We live stream it live on Saturday via Zoom. The replays are available for you on Sunday. So if you miss a spot on Saturday, guess what? You can watch on Sunday. You know, it's a great starting point class for you guys. And normally it's $97. We dropped the price to $49. The earliest we've gone is from 9 to 3. Usually we go 9 to 6, 9 to 7. I'm on as long as you have questions. I love to help you guys interact and network to share a little bit about where you're looking to invest, what your focus is. And like I said, we usually do this the 3rd or 4th Saturday of the month. It just varies a little bit. But if you go to noteweekend.com and get signed up tonight, guys, we've got some bonuses that we're going to throw in, some really great deals for you to help you really take things to the whole next level. But what do we cover? Well, the first part of the day is all about finding deals. Where do you find these deals? What do you say? What don't you say? All right, because you don't want to shoot yourself in the foot when you're on the phone with banks, okay? So we'll talk about what exactly you say, how you say it, the lingo, the wording, so that the banks are sending you stuff, they take you seriously. If you don't have the capital, don't worry about it. We'll show you how to find OPM, other people's money in counties around you. We'll show you how to tap into those 12,000 IRA investors in the Kansas City area or wherever you're located, okay? We'll also talk about the different exit strategies to make money. There's a variety of like 10 to 11 different strategies, because it's important not just to buy something, but to make some money immediately, and the different ways to do that. We'll talk about the different vendors and the team that you have to have in place for these. This is not difficult. No, you're not paying huge amount of fees in the front end. You're going to need attorneys. You're going to need some real estate agents. You're going to need a servicing company. You need people to go out and take a look at the property for you. You're not going to jump on a plane. You could literally do this business from your home and buy deals all across the country, okay? So your team and vendor will help you do that. You don't have to do it all. We'll talk about the different loan trading platforms that you can buy and look at assets right now. And we'll cover a lot more like marketing and other things, legal side. We'll talk about some of the ways that you can raise capital creatively, different structures, how to, if you use your own money, how to cash that money out. Lots of great stuff for you. And like I said, if you go to noteweekend.com, guys and gals, you can join in for just $49. So that's not enough for you. I'm going to throw in some more bonuses to really take away all the doubts that you might have. Okay. I'm going to throw in the class normal. Like I said, 99, we do it for 49. We're going to throw in a 4-hour training thing called our Calling Banks training. This is where yours truly On a Wednesday afternoon, basically from noon to 4, 1 to 5, I will jump on the phone and call banks for hours, and you can join in and watch. You can ask questions. You can hear the lingo. You can hear the conversations back and forth. You can see how I follow up, who I follow up, what questions do I ask, and see the deal flow rolling in. And people love this because it's a lot easier than they most think. Most people are like scared to death to pick up the phone and call. I show you, boom. If I can knock out 50 phone calls in a few hours, you can do this on a regular basis too. It's not that difficult, but it's also one of the biggest bang for the bucks in finding deals out there. And those that get ahead in life are those that are willing to do a little bit more than what everybody else is willing to do. That's normally 49 bucks. We throw that in. I'm going to throw in the Bauer financial list, the most recent quarterly report for you guys as well. This is usually somewhere between a $300 and $400 purchase. I think last quarter was $360. We'll throw that in so you can see the banks that we call. You'll see the percentages. You'll see who has what and what their default rates are and what they have on their defaulted books. Yeah, that makes it really easy to target the banks that you call. We'll also do a 30-minute one-on-one call with me after the event. I charge $1,000 per hour for consulting. All right. So it's a $500 value there for me to sit down with you, kind of go through, make sure you're going off in the right direction to make sure that, okay, these are the areas I'm looking at buying. Is this a good thing? What should I target? Who should I target? That's worth $500 right there. We'll also throw in the replays we talked about to the previous event and this event. If you've got a spouse or a business partner that you'd love to have them attend as well too, we'll throw that in there for you. And then of course, we've got an amazing Facebook group of over 900 investors, 900 students of ours who are doing amazing things. It's a great resource to find deals, to find funding, to help people that look at your assets, to ask questions. That's included there for you. So over really $1,200, $1,300, maybe $1,500. I haven't added it all up, but in bonuses for you guys, it's all for just 49 bucks. Okay. And I'll throw in one thing more. If you go through the class, you're like, Scott, you haven't given me value. I don't think this is for me. I'll gladly refund your ticket. No question asked. Okay. Trust me, I'm by far not getting ahead of $49. I will tell you this though, what I am is that the 1,000 people that I want to help, that 1,000 people not only becomes an amazing network for me, but for you guys as well. People that understand the note business, people that I can send deals to, people that if I have deals in their neck of the woods, they can go take a look at it for me and either evaluate it for themselves or help me out of the deal. That's the whole reason, everybody. I'm trying to build a note army again here as we see things getting worse out there to take advantage of the opportunities out there and really create some win-win-win scenarios. Win for us, win for the banks, and win for the borrowers. And I would love for you guys to be a part of that. So if you just go to noteweekend.com, you can get signed up there. And like I said, whatever your goal is, ladies and gentlemen, whatever your goal is long-term, retire, spend more time with your spouse, have them retire, put your kids through college, retire your parents, travel more, have more fun, or update your toys, your house, whatever it might be. We know it needs cash, or you need to be in the note business to make things happen. And now is an amazing time to do that. So get signed up tonight, noteweekend.com. Love for you guys to be a part of it. Go there. You can actually see the schedule. Click on the RSVP now. That'll take you to the checkout page. Put your credit card information in there. And for $49, you get started being a note investor out there for you guys. So I'd love to open it up now. If there's any questions for any of you guys out there tonight, I'd love to answer those for you and leave it open for you guys. So if you're watching this on the replay, feel free to ask your questions in the Facebook or the YouTube comment section. We're glad to answer those. We moderate those continuously to see as people are asking questions. I know you have questions. We want to be the ones to help answer you there. And we'd love for you to be a part of our extended note family. So go to noteweekend.com, everybody. Sign up now and sign up as soon as you get it. As soon as we get this, you'll get a link, an email with access to the previous class. You can start watching that stuff. So the next time the class rolls around here in the next week, you'll be ready to rock and roll, and even more dangerous, and be ready to buy some notes. So I want to thank you guys for joining in and being a part of it tonight, taking an hour of your busy schedule to join me here on the Note Nation Top 40 Tour. Go out, take some action, everybody, and we'll hopefully see you at the next Note Weekend class. Bye, everybody.